Hello everyone and welcome back to the sessions on derivatives for CFA Level 1. In the previous class of derivatives, we started learning the basics of options. And before I move any further, let's quickly have a recap of what we have learned in the previous class. What are options? Options are such derivative contracts where the holder of the option is having a right, only right, not an obligation to perform. That means whether the settlement should take place or not is completely at the discretion or the choice or the option of the holder. That is why it is termed as option. So there are two parties involved. So the next question was obviously, who are the parties involved? One party out of the two is the buyer of the option, one is the seller of the option. The buyer of the option is also known as option holder. The seller of the option is also known as option writer. So buyer of the option buying the option will be holder of the option and will have the choice whether the contract should be settled or not. If the holder of the option chooses to settle the contract, the writer of the option, that is the counterparty, will be under obligation to perform. The writer cannot deny. If the holder has demanded settlement, writer will have to comply with that. What is the strike price? Now you have understood one thing, that derivative contracts are meant for settlement in the future, but at a price which is agreed today. So the price which is agreed today to buy something or sell something in the future, and that something is the underlying, then such price is the strike price. It is also known as exercise price. What are call and put options? When the option conveys the right to buy, it is termed as a call option. When the option conveys the right to sell, it is a put option. What are American and European options? If the option is exercisable only at a specified date, it is a European option. Whereas when an option is exercisable at any date up to the mentioned date. So for example, if I mention a date 31st August 2025 and I mention that it is an American option, then the option is exercisable on or before that date. Means these options are exercisable immediately the moment they come into existence, and they will expire at the specified date. So options that can be settled or which can be exercised on or before a specified date are American options. Whereas if the option is exercisable only and only at the mentioned date or a specified date, it will be considered as a European option. What is the price of an option? This is the price that is paid by the option holder to the option writer. Means option buyer will pay the price of the option to the option writer or option seller. Don't get confused this with the strike price or exercise price. Strike price or exercise price is the agreed price for the underlying, but to get this option, the price that you pay is basically the price of the option. And you should be clear with one thing, price of the option is known as option premium. So the obvious last question over here is, what is option premium? It is basically the price of the option which is paid by whom to whom? Paid by the buyer of the option to the seller of the option. When it is paid upfront, and once paid it becomes the expense for the buyer and income for the seller. Whether the option is exercised or not in the future, which will be dependent on the choice made by the option holder, but option premium once paid, it can never be reversed. So have a quick look at these important questions relating to option basics, and then I take you ahead. Alright friends, time for us to move ahead and discuss the next point. Position of option holder. When we say position of an option holder, there can be three possible positions of an option holder. Three possible positions of an option holder. In the money, at the money, out of the money. And these are the terms used in real life. So it's not just bookish content what you are learning. In real life, we identify the position of an option holder as in the money, at the money, or out of the money. So what is the meaning of option being in the money or option holder in a position which is called in the money? Simple point. When exercising an option, it is becoming beneficial for the option holder. The holder's position is in the money. When exercising an option will result into a loss to the option holder, we say the position of the option holder is out of the money. When exercising an option does not make any difference to the option holder at all, that means the option holder is indifferent with either exercising the option or let it go, then we say the option holder's position is at the money. In the money, at the money, out of the money. I want you people to wire these terms into your brains so that you should be comfortable using these terms in our discussions ahead. Let me explain this through an example. Say, we decide to talk about a call option. A call option has a strike price of $50. That means, first of all, call option conveys the right to buy. So suppose you are holding a call option, means you have the right to buy the share at $50. I am assuming that the underlying asset is an equity share, say equity share of some corporation. So a corporate entity, its equity share which is traded in the market, that is the underlying instrument in our example. And the strike price is $50, means you have the right to buy, because it is call option, you have a right to buy that share at $50. Now suppose the prevailing market price of that share is $54. Now think, I want you not to be mechanical over here, just logically think, if the market price of that share is $54, but you are having the right to buy it at $50, common sense, something whose price is 54 but you have the right to buy it at just $50, aren't you going to be benefited if you exercise your option? The answer is yes. As an option holder, you will be benefited if you exercise this option. So this becomes an option which is in the money for you. Therefore, your position as an option holder is termed as in the money. Suppose the market price of the share was exactly $50, means you have the right to buy the share at $50. The market price is also $50. Then whether you exercise the option or not, it doesn't make any difference. So your position is at the money. At the money means no profit, no loss. In the money, profitable position. And out of the money means loss making position. For example, if the market price of the share has dropped to $48, now you will be an idiot if you exercise your option, because in the open market you can buy the share at $48. Why would you exercise your option and buy the same share at $50 when easily it is tradable in the open market at $48? If you exercise your option, you will have to pay extra. That $2 extra what you are paying is a loss to you, and that is why your position is termed as out of the money. So position could be in the money, at the money, out of the money. Let us write some important notes in this regard first, and then we proceed ahead. If exercising the option benefits the option holder, then his position is in the money. If option holder suffers a loss on exercising the option, then his position is out of the money. Where option holder is indifferent with whether to exercise the option or not, then such position is known as at the money. Option holder will exercise the option only when his position is in the money. I want you to carefully take note of these important points and then we move ahead. Alright friends, once you have completed writing this whole thing, what I am going to do, I'll put forward a small example and I'll give you a few minutes to attempt that example, and you need to just try giving your answer over there. And here is that example. I'll give you maybe 1.5 minutes to identify the answers for each of these, and let me see within 1.5 minutes, that is exactly 90 seconds from now, are you able to identify the correct answers for all? So I've given you 90 seconds, your time starts now. Alright friends, I've given you enough time to attempt this. Let me quickly discuss out this with you. Look at this. The first 4 options are call options, the later 4 options over here are put options. Look at the status. First one, strike price or exercise price is 60 and market price is 55. Something which is available in the market at 55, you have the right to buy, because it's a call option, it indicates the right to buy. You have the right to buy at 60. Why should you exercise the right to buy at 60 when something is available just at 55? So it is clearly out of the money. Second part, both exercise price and market price are same, so it is at the money, no brainers required. Third and fourth are similar to the first one. Look at simply one thing, it's a call option and exercise price is greater than market price, so third and fourth are also out of the money. So in the first 4 options, first one out of the money, second one at the money, then out of the money, then out of the money. Now look at the 5th one. It is a put option, means it is conveying the right to sell. You have the right to sell at 110 and prevailing market price is just 100, means you have the right to sell it at a higher price. Here if you exercise your option, you will be benefited. So it is this 5th option which is in the money, and the other 3, later 3, options 6, 7 and 8 all are out of the money, because these are put options and you have the right to sell at a price which is lower than the prevailing market price. If you exercise these options, you will incur loss. So I have just theoretically and conceptually discussed the answers of these. You may just quickly write up the outcome of this. So you may take a screenshot or you may quickly write down in the book itself where the question is given. You can add one more column to that question, that is position. Either it is out of the money, at the money or in the money. So just write it quickly and then I take you ahead. Alright friends, I am sure you have completed this whole thing. Let us now take up a little better question. Example 2. Here I will give you 3 minutes time to think over this and be ready with your answers, and let me see in 3 minutes time are you able to answer all of these correct. So I have given you 3 minutes time, your time starts now. Alright friends, I have given you enough time to attempt it, and 3 minutes time what I have given you is over. Let me now explain to you what you need to do in each of these cases. At least let me explain the first 3 cases. Now if I read this question, it says information with respect to options that will expire after 3 months is available. What kind of option would you opt for? That means what kind of option means here it is either the call or put option that you should opt for, and what action would you take on expiry date. So that means we have to take decisions at two different stages. One was at the time of entering into the option contract, which type of option you should choose. Another was at the time of settlement, whether you should exercise that option or not. Now, simple common sense, the life of that option contract is 3 months. So first of all, what is going to happen after 3 months? We are clueless, we don't know, correct? We don't know what is happening after 3 months. Simple point is, actual price on expiry, you will never know initially. That means while answering the first part, that is what kind of option would you opt for, you cannot consider this information at all. Are we clear that we cannot consider this information at all? Now, focus point will be only these two information data. So, first case, exercise price of something is 180, expected price is 160, means after 3 months you believe that the market price is going to be 160, correct? You believe that the market price is going to be 160. So what you would want to do at 180? What you would want to do at 180? Something whose market price is going to be 160, at 180, are you going to buy it? No, you are not going to buy it. At 180, will you prefer selling it? 100% yes, you will prefer selling it at 180. This is how you need to think. If you want to sell it at 180, that means you should be a put buyer. That means you should buy the put option, you should hold the put option. That means your choice over here will be not a call option but a put option. So that you have the right to sell it at 180, where your expectation is that on settlement the price will be 160. However, you took that put option and you waited for 3 months, and at the end when you arrive at the maturity or expiry date, you find that the market price, the actual market price is 180. So you have the right to sell it at 180. The actual market price is also 180. Your position is identified as at the money, and because it is at the money, you are not going to exercise the option. You will let the option lapse, means the option will not be exercised. That is how we apply the thinking process in case 1. Let us also discuss case 2. In case 2, 125 is the exercise price. Your expected price is also 125, means you have the right to buy or sell something at 125. You believe that on the settlement date its actual price is going to be 125, means if I just look at these two information, you will never be benefited by a call or put either type of options. So you don't buy any option over here, because buying an option won't happen free of cost. You'll have to pay the premium, right? You have to pay the price to buy the option. Options are not purchasable freely. You have to pay something to get that option, correct? And as a result, you don't make any choice in the second case. That is how you need to think. Let us explore the third, and I'm not even looking at what is the actual price on expiry, because if you haven't taken any option, no question of exercising or leaving it arises, correct? 160, 175. Something whose price is going to be 175, that is your expectation, and its right to buy or sell is at 160. Think, something whose price is 175, will I be happy to buy it at 160? Answer is yes, I'll be happy to buy it at 160. I don't want to sell it at 160 if its price is 175. Something whose worth is 175, I will not prefer selling it at 160, rather I'll prefer buying it at 160. So I will prefer taking a call option over here in the third case. Now look at one thing. This is the strike price. This is the exercise price. Means you have the right to buy the share at 160. And when you come to the expiry, the actual price is 155. Actual price is 155. That means you are holding a call option, conveying a right to buy at 160. And its actual price in the market is just 155. Why would you exercise your option and face a loss? Basically, your position went out of the money. Do you agree with me? Your position went out of the money. If your position went out of the money, there's no question that you exercise this option. What I'll do is, I will give you the analysis of the first 3 cases, which you can note down, and the later 6 cases, I'll once again give you a chance to try out and see if you can give me the correct answers. So let's do one thing. Let's first write up the answers for the first 3 cases that we have just discussed. Case 1, choice, position on expiry, action to be taken on expiry, become a put option holder is the choice. Position on expiry is at the money, so you don't exercise the option, you let it lapse. Case 2, what was the choice? You did not make any choice, so matter ends then and there. Case 3, choice, position on expiry, action to be taken on expiry. So the choice that you made was to become a call option holder, position on expiry was out of the money, and action to be taken on expiry, you let it lapse because you are not going to exercise an option which is out of the money. So quickly take note of this much, and then I'll give you some more time to think and try the later 6 cases. Alright friends, once this much is done, let me show you this whole thing in a tabulated format so that you just write your answers over here, and I'll give you another 2 minutes to think and fill in the blanks. I've given you 2 minutes time. Your time starts now. Alright friends, I've given you enough time to attempt it, and these are going to be your correct answers. Please take note of this and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead, and now we talk about a very important concept, that is intrinsic value or gross payoff for both parties. When I say both parties, it's basically the option holder and option writer. Now here I want you to get involved in this whole thinking process. Please carefully analyze whatever I am discussing with you. And what we will do, we'll first understand the whole thing from the viewpoint of a call option. Then we will apply the thought process over put options. So what is a call option? You know one thing, call option is basically some instrument that is conveying to you the right to buy the underlying. So let us keep it simple. You hold a call option. Mark my example in your minds. You hold a call option with a strike price of $50. Strike price is $50, means you have the right to buy at $50. The prevailing market price is $56. So what will be your thought process? Something whose price is $56, you are getting it just at $50. If you exercise your right, you will get it at $50. So if you exercise this option, what benefit you get is the intrinsic value of the option. So market price of that share was $56, but you have the right to buy it at $50. So you exercise your option and you get that benefit of $6. That $6 becomes the intrinsic value or the gross payoff for the option holder. For the option holder. So option holder is going to claim that money from the option writer. So whatever be the positive payoff for the holder becomes a negative payoff for the writer. And understand one thing, payoff, this term payoff is to be interpreted as profit. So what profit holder is getting, exactly same amount of loss the writer will incur. So when will a call option be exercised? If you again recollect the example that we have taken, you had the right to buy at $50. If the market price was $47, you will not exercise your option, correct? Because it goes out of the money. If the market price was $50, you still won't exercise your option because it is at the money. You will exercise your option only when it is in the money. What is the condition for a call option to be in the money? The market price should be greater than the exercise price. So in case of call options, when the market price is greater than the exercise price, you find that the option is worth exercising, means the option becomes in the money. So where it is in the money, you will exercise it. If it is at the money or out of the money, you will not exercise it, you will let it lapse. That is how we deal with call option, because it conveys the right to buy. In case of put options, how should you think? If it was the same example that you have the put option, you have the right to sell at $50. If the market price is $56, why would you exercise your option to sell it at $50? In the open market, if you are getting $56 by selling the share, you will not exercise your option. So a put option is exercised only when the market price is lower than the strike price or exercise price. So imagine the other situation. What if the share's market price goes to $47, but you have the right to sell it at $50? Will you exercise your option? Answer is yes, you will exercise your option. So a put option is exercised only when the market price is lower than the strike price or exercise price. So let's do one thing. With these discussions and the examples that I have conveyed to you verbally, let us write down some very important notes, and once we have written these notes, we will again enter into this discussion and make sure that things are completely clear without any confusions or doubts. So let's first write some important notes over here. So under the heading intrinsic value or gross payoff for both the parties, you write the first point over here, that a call option is exercised by the holder only when the prevailing market price is higher than the strike price, that is MP, market price, should be greater than EP, that is exercise price. On the other side, a put option is exercised by the holder only when the prevailing market price is lower than the strike price, that is MP less than EP, MP standing for market price, EP standing for exercise price. The gross payoff for the option indicates its value on the date it is exercisable. That gross payoff is also known as intrinsic value of the option. So please write up this whole content and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and discuss something very important, and keeping the focus right now on call options. If it is a call option, we identify the situation into two different scenarios. One where MP is greater than EP. This is where the call option gets exercised, because this is where the call option will be in the money. This is the scenario where the call option will be either at the money or going out of the money, and this is the point where you do not exercise the call option. So when this is the scenario, you exercise the call option. So call option gets exercised, and in this scenario it is not exercised. So when call option is exercised, what is the intrinsic value of that call option? Its intrinsic value or gross payoff will be MP minus EP. Now, over here, I want you people to logically understand this matter. I don't want you to mechanically understand it. I want you to logically understand it. First of all, we are dealing with call option. A call option conveys the right to buy. So if you are a holder of a call option, taking the same example, exercise price of that call option is $50. Prevailing market price is $56. So how do you think? If the market price of something is $56, but you have the right to buy it at $50, you will be benefited. The question is, you will be benefited by how much? You will be benefited by $6. And that is where you exercise the option because it is in the money. By what value you got benefited? So the intrinsic value is MP minus EP. In my example, the MP, the market price was $56 and EP, exercise price, was $50. So 56 minus 50 gives you a $6 payoff. That's a positive payoff. It's a profit. But do you know, we call this as gross payoff. Gross payoff basically means gross profit. So holder got a profit of $6. We are calling this as gross payoff or gross profit. Do you know why we are calling this as gross payoff or gross profit? Because to get this option, to acquire this option, to buy this option, the holder would have paid the premium initially, right? Suppose the holder has paid a premium of $1. Then your net payoff is gross payoff minus the premium that you have paid. So your net payoff will be how much? Your net payoff will be $5. So you have to understand, gross payoff is the gross profit, net payoff is a net profit. Gross payoff is also referred to as the intrinsic value of the option. Why gross payoff is referred to as intrinsic value of the option? Because on that day, the option was worth that much. Simple logic, simple logic. A share whose market price is $56, you have an option which is conveying to you the right to buy at just $50. So exercising that option, you are benefited by $6. If by exercising that option you are benefited by $6, that $6 is the worth of that option. So you know, we talk about all these instruments as derivatives because they derive the value from the price movement of the underlying. So the day this option came into emergence, that day when the option contract was initiated, its value we did not know how much it was. But with the gradual price movement of the share price moving upward, the call option attains the value. So when the price of the underlying went to $56, but you have the right to buy it at $50, your option became valuable. It is because of that option that you are getting benefit of $6. So worth of your option is $6. This is called the intrinsic value and this is called the gross payoff. When we are using the word gross payoff, it is gross profit, and subtracting premium from that, you arrive at the net payoff or net profit. Now, this intrinsic value you will find when the option is exercised in this scenario, right? What will happen when you are at this scenario, when you are not exercising the option? Whether the option is at the money or out of the money, option holder is not an idiot to exercise the option when it is getting, a loss making situation. That means option will not be exercised when there is a loss. That means when it is out of the money or at the money, the option is not exercised. When it is not exercised means the worth of that option is zero. So in fact at this part you don't have to use your brain. If it is this scenario, you will simply conclude that the gross payoff or intrinsic value is zero. And the matter ends over there. That's it. But gross payoff is zero. If option holder has paid $1 premium to acquire this option earlier, that $1 is your expense, that is expense for the holder. That $1 will be subtracted from this 0 to arrive at the net payoff, and net payoff will become negative. But that is not our concern right now. Our concern right now is to define. Do you remember when we started this whole discussion, the heading that we have placed was not about net payoff. It is about the gross payoff or intrinsic value. So the gross payoff or intrinsic value at this stage is 0, and over here it is MP minus EP, which in our example was $6. Logically, imagine yourself to be option holder, and if I am the option writer, this $6 payoff I will have to pay to you. So for me, it is a cash outflow. That means it is minus $6. For you, it is a cash inflow. That is a plus $6. So if for you it is a plus $6, then MP minus EP is an inflow for you, but MP minus EP will become outflow for me. Therefore, what is to be done? Let me show you in detail over here. Look at this continuation of the chart ahead. When we are at this scenario, you split this scenario into two. That is, for the holder, the gross payoff will be, you took MP minus EP as the value of the option. Outside the value of the option, when MP minus EP we are putting within brackets, and which in our example was $56 minus $50, that was $6, and we have put a plus sign outside the bracket, which indicates an inflow of cash. So for the holder, that $6 will be inflow. Plus sign outside the bracket. When you open the bracket, it remains MP minus EP, which will be still a positive $6. And what happens to the writer? For the writer, the gross payoff, the value of the option is still MP minus EP, but it is the writer who will have to pay that value from its pocket. So for the writer, outside the bracket, you will put a minus sign because it's a cash outflow. So it is negative sign outside the bracket, and within brackets you have MP minus EP. When you open the bracket, it becomes minus MP, and then minus of minus will become plus EP. That means the scenario becomes EP minus MP. In our example, it will be $50 minus $56. It will be a $6 loss. That is the gross payoff for the writer. So what was the benefit to the holder becomes a loss to the writer. Before I take you any further, I want you to note this entire chart. Alright friends, I am sure you have completed writing this whole thing. Now let us move ahead and deal with put options. In case of put options, we classify the scenario into two different categories. One where the market price is lower than exercise price. This is where the put option becomes exercisable because the put option will be in the money. And over here, the put option goes at the money or out of the money. So over here, if you land up at this scenario for a put option, the put option gets exercised. If you land up at this scenario, the put option is not exercised. So when any option is not exercised, its intrinsic value will be 0. So you don't have to use your brain over here. The intrinsic value over here will be 0. But the intrinsic value over here will be EP minus MP, that is exercise price minus the market price. And if not exercised, the intrinsic value is simply going to be 0. So this intrinsic value or the gross payoff, for the holder it becomes a cash inflow, and for the writer it becomes a cash outflow. So if I want to find the payoff for the holder, I will take EP minus MP, and outside the bracket I will put a plus sign for the holder, plus sign outside the bracket, and for the writer minus sign outside the bracket. So for the holder it is EP minus MP, and for the writer it is MP minus EP. Please write up this chart as well for put option, and then I take you ahead.